I want to welcome everyone to our first of the year Weinberg Center Symposium on telling your company's story, the board's role in disclosure. First of all, boilerplate. The roundtable, oddly enough, for the first time, we're not going by Chatham House rules. This is going to be open and not subject to it, and so it is an open discussion. Number two, for those of you who are looking for the CPE credits, we want to thank our partner, Sally May, who has arranged to do the CPA, get us CPE credits. So for those CPEers, it's a good thing, and there's CLE too. But you have to sign in and sign out appropriately at the outside tables. Following the program, we're going to have a lunch outside, and to which obviously everyone here is invited. This begins our 17th year doing this, which is really amazing. It's fantastic we've survived that long and will continue to survive. The center obviously was formed in 2000 to create a forum for discussion of relevant governance issues amongst the Delaware judiciary, the legal community, finance community, director community, auditing community, and that's in fact what we're doing today. This will be actually the fourth time we've co-sponsored with our great friends at the Center for Audit Quality. They are a terrific organization. Their executive director leader is on our advisory board, and she is partially responsible for this program. So if it really turns out well, thank her. If it really turns out badly, blame me. Or blame John White, but then more on that in a second. Anyway, but
we'll blame you, Charles.
Oh, thanks, John. He's on our advisory board too. I'll take the blame. But the program today is an interesting topic, and it's on obviously disclosure. And it's I've told this story, and this will be the third time John's heard it, so he can still laugh, I hope. But when
I raise my hand, they should laugh.
Yes, that's right. Please. But this is an interesting topic for governance. Obviously, it's a governance center. We do governance topics, and this is different in the sense that it's disclosure, but it's how disclosure and the boards relate to disclosure, which is a governance topic. You know, what is the board's role in overseeing the disclosure process? What should the board do in encouraging disclosure? And what are the board's potential responsibilities, liabilities, duties vis-a-vis that process, which is really critical. Disclosure really is sort of twofold. It's an SEC issue, and we have an SEC representative here, where a lot of disclosure we see today is federally mandated. On the other hand, state law has effective requirements too. More fiduciary. There's not statutory, but there's an obligation, obviously, to keep your investors informed, keep your shareholders informed. And how that should be done and how much should be done is the subject, obviously, of federal regulation, but also state law fiduciary duty. And that's as the disclosure regime becomes broader, and there are more active investors than there were who demand much more sophisticated information than they did. What should the board be doing or not doing in this particular area? Now, it's funny talking about this because this is the joke, not a joke, true story. About, I don't know, probably 26 years ago when I started out teaching at Stetson Law School, I wrote an article on corporate governance. It was actually on director compensation. I think copies may be outside, believe it or not. And I'd spent the summer writing this thing, working on this thing. And at that time, there was a professor, retired professor from the University of Michigan Law School, kind of Al Kennard, very famous corporate law teacher. If you go to law school, there's Kennard's casebook was kind of legendary. And he said, "So what are you doing, young man?" I said, "Oh, I'm writing about this." I gave him this paper on director compensation and this thing called corporate governance. And he looked at me and he said, "May I give you some advice, young man?" I said, "Yes, sir." He said, "Don't waste your time on something as silly as corporate governance and what directors get paid." He said, "If you really want to go far in this business, focus on disclosure." And I was like, oh, great. I just spent the whole summer doing this. And, but to heck with it. I'm just going to publish it and move on. And anyway, I ended up staying in this field, and probably about 7-8 years later, I get this handwritten note from Al. It was funny. Out of the blue, the letter shows up. Actually, no, it came here. It was 10 years later. He was in a retirement home somewhere, I think, in mid-Pennsylvania. And he wrote back, he said, "Dear Charles, sorry, I was wrong. Al. But doggone it, we're back to disclosure. Here I am again. So actually, dear Al, you were right. Sorry,
Yes.
Charles. Anyway, but this panel is particularly interesting, and this really is the brainchild, if you will, of John White. John has been on our advisory board for a long time. He's a senior partner at Cravath, and he runs their governance practice at Cravath in New York, and had been at the SEC as director of the Division of Corporate Finance. And John is always great in suggesting programs, and he said, this is one we really ought to do. We really ought to do it. And I listened, and I said, despite my my Al Kennard story, I think it's a good idea. And so really this was John's inspiration, and we went to the Center for Audit Quality, and they were excited about it too. It fit neatly into what they were doing and what we were doing and what John had in mind. So today's program, I think, should be a lot of fun, because it's a blend, obviously, of a federal disclosure, state disclosure, and general corporate governance. So what should the board be doing or not doing in that arena? I want to briefly thank those from the center who helped really put this thing together. Certainly, Ann Muley, Louisa Crescent, Jerry, our interns, who did a terrific job in assembling this. It takes a lot of work. This is kind of like doing a wedding, maybe on a slightly lower. This food is a little different, but nonetheless, it's a lot of organization. And appreciate everything they've done. And we also appreciate the support of the University of Delaware and the College of Arts and Sciences, under which we operate. Dean Watson has been a terrific friend of ours and a great sponsor of what we're doing. So thank you all, too. Let me quickly introduce the panel. John is, I've already basically introduced John. John from Cravath and formerly SEC and certainly a real leader and thought leader in this particular field, and a long-time advisory board member. And so easy to introduce John because his titles are so, it's hard, you don't have to explain his titles, they're pretty clear. But we are delighted he's with us, and he's been a great friend to the center for a long time, and it's a good idea. Good idea, John. Good program. And he even laughs at my jokes sometimes. Seated next to Seated next to John is another very long time. I mean, from basically the start. Peggy Ferran is actually here today as a corporate director. She's on the board of Oxy Petroleum. She chairs the compensation committee and had chaired the nominating governance committee, and is in capacity today as a director. But in her other job, she is sort of a legend in the corporate governance field. She is the corporate secretary of Prudential Insurance. Prior to that, she had been at Pfizer and also at Sara Lee. But Peggy Ferran is kind of one of the icons in this field. She was very, very early on promoting good governance at Pfizer, way back, and she, was through various positions, the Society of Governance Professionals and the American Bar Association. We've been on a million things together over the years, and she's been active in the center really from its start. And we are really excited to have Peggy back, and thank you. But she's wearing her director hat today. She's not wearing her corporate secretary hat. So we won't talk about corporate secretary. She's a director today. But again, a legend in the field. Seated next to Peggy is Doug Main. Doug Main retired as CFO of IBM. He's also here in a directorial capacity today. He's on 3 boards, on audit committees and governance committees, and he again offers us tremendous perspective. He and I are on the, actually with John too, the standing advisory group of the Public Company Accounting Oversight Board. Students in the class remember that was a quiz question, PCAOB, and the 3 of us are both on that thing. And Peggy was on that as well a while back. But Doug comes to us with obviously significant finance experience coming from the CFO position at IBM, but he's now at Brown Brothers Harriman as a limited partner and serves as a corporate director on 3 large company boards. And again, we thought the director perspective here was important on what can directors do or shouldn't do in this particular situation. Seated next to Doug is Sharon King, who is with here. Let me get that. Oops, Virag, who is with. God, this is terrible. My eyes are blanking. Aetna Insurance. She's the chief accounting officer at Aetna. And Aetna obviously is a Fortune 50 company. And we thought it was important on the disclosure side to have someone who understood what, from an internal process, how the numbers came together and how disclosure was done. Because typically, disclosure that comes out is generally financial disclosure. And someone who's the chief the controller, chief accounting officer, and responsible for that is really the critical, I guess, centerpiece, if you will, of disclosure within the organization itself. And obviously, Sharon's activities at Aetna makes her uniquely qualified for this discussion. So we are delighted that Sharon joins us too. And this is your first time here. So she also used to work with an old colleague of mine who was general counsel who just retired, who I know was very tough on disclosure, but a lot of fun to deal with as well. But we're delighted Sharon could be with us. Seated next to Sharon is Cynthia Fornelli, who I mentioned earlier, who's Executive Director of the Center for Audit Quality, also long time active in the center and now on our advisory board as well. The CAQ, which she runs, is really I guess the professional organization of the large accounting firms in the United States, and it's designed basically to create standards and work with the firms and work with the regulators to ensure the most effective and best possible audits. And I think from her perspective, part of auditing is disclosure. And so she will come at this from the perspective of basically the audit industry itself and how it looks at and thinks about disclosure. Very important. Our next participant down the line, one more, is Eileen Cohen from J.P. Morgan Asset Management. She represents the investor side because, frankly, disclosure has to go to someone, and that's who it goes to. I mean, that's the point of disclosure, isn't to disclose, it's to go to the investors. And she has been active in J.P. Morgan. She was in Invesco before Morgan, and basically does their engagement activities at Morgan, which is significant. And those are the folks to whom the disclosure goes. And if it's not effective enough, those who will communicate to the companies or to the regulators the lack thereof. And so this is her first time here, and we're excited and delighted that she is here. Seated one more down is Robert Evans from the Securities and Exchange Commission, who is basically is Deputy Director for Legal and Regulatory Policy, but actually you're now Director of International Corporate Finance for the Commission. He had been, prior to that, partner at Sherman & Sterling in New York, and a very well-known securities lawyer, and this was his field too, as was John's. And this is his first time here as well, and we're delighted that he could join us. Though I know we're going to get some good SEC boilerplate, but I'll let him do that. The views are his own, not the Commission's, but that's going to be his job. And finally, last but certainly not least, we always in this program have the Delaware judges. Judges typically get the last word. Regulators kind of do. That's why Rob is kind of over on the end. But ultimately, the judges in Delaware really do. And Judge Noble, former Vice Chancellor Noble, has been a long-term friend of the center, going way, way back. And John was on the Court of Chancery for you were 12 years, full term, and has been a great participant in this. And he's very, very recently retired from the bench and gone to Morris James, a great law firm in Wilmington. And frankly, no one, ultimately, in deciding directors' duties, the judge gets the final word. And there's frankly no one out there who better can give us the final word. Though I guess it's at this point, now that you're retired, it's the sort of final word, right? Or not so final. But John has followed this area for years and is really a great expert in director of fiduciary duty and director of practice. And we thought he'd be a terrific cleanup person to bring us all together. Though, as he jokingly said, the problem with being the last on the panel is all the good ideas have been taken. But John always has good ideas, and we're excited to have him back with us as well. With that, what we plan to do is we'd like to start with some introductory comments from the panel. We'll have some good discussion following those comments, and then we'll go to the audience for questions and whatnot. We'll start, by the way, the students will get the first dibs, because this technically is Finance 418. That's why they had to sign in. And hopefully no one was late. No one was late. And then we'll go to the audience for general questions. We'll try to wrap this up probably about 11:30 or so, 11:45, depending on how good the discussion is going. And we're, as I said, delighted y'all are here. And I will turn it over to John, who will A, make his comments, but B, well, A, set the stage, and B, give his comments on setting the stage for everyone else. John.
Thank you, Charles, and thank you for agreeing to do this program. I guess my professional life, at least, seems to center around disclosure all the time. And most of the time I spend my time working with management on disclosure issues. But I'm always wrestling with the issue of, well, where's the board here, and what should they be doing, and how should they be involved? And Charles, I really welcome the opportunity that you've given us to put together this terrific panel and explore that issue. So there's a lot of discussion these days about corporate disclosure, and just to mention, a couple of reference points, we certainly have investor interest, or maybe I should say investor demands for more robust disclosure. Everything from risk disclosures to cybersecurity to governance practices to sustainability. There's a great deal of investor interest. The SEC has become very involved recently with their disclosure effectiveness initiative. That's been in process now for a couple of years. It ranges, there are different versions of it you hear, but it ranges from eliminating repetition and focusing on capital formation.
Don't steal my part of the talk.
Okay. It ranges from eliminating repetition and focusing on capital formation to potentially expanding disclosure in areas such as sustainability or political contributions or various areas. On the financial front, there's a great deal of focus on non-GAAP disclosures. Cindy, I know this is your area, and we'll be getting to that. But again, just a particular area where we'll get to, I think the board should be thinking about it. And there's also been, I guess I'd say, an increased focus on how the mechanics of disclosure. I mean, everything from using social media to focusing on shareholder engagement, which is really disclosure in another form. And I think we all understand that in all this push for additional or re-examination of disclosure, that management plays a critical role in all of that. But that's not really our topic today. Our topic today is what should the board be doing? And that, as each of our panelists, as we go down the panel here, I hope that's what we can focus on, because I think that's what I would like us to explore. And I guess I'd have to say, what better place than Delaware to do that? So Charles told me I was supposed to talk about the law. Well, that's extremely easy on this one, and it's very straightforward. We all know that a board has a fiduciary responsibility to oversee the business and affairs of the company. And the business and affairs of the company includes substantive disclosure and the process for disclosure. So, that's kind of, that's it on the law, Charles. I mean, there isn't...
John, I could have done that. Sorry, go ahead.
But what we want to go on is to, in effect, kind of go beyond that and ask ourselves, what should the board's role be? So let me just offer one easy one, and then we'll go on, and I want to give you a framework for others to look at it. But one easy observation is that, for me at least, the board has an all-important role with respect to tone at the top. If you want to have disclosure that is robust and fair and responsive to investor demands and investor needs, the board has got to set the example. If it doesn't, it's much, much harder to get there. So to me, that's an easy one in terms of what board role should be. There are several, probably half a dozen now, SEC speeches out on this. Wes Bricker and Mary Jo have both given a whole, it just shows up time and time again in their speeches about the importance of the role. So that I guess is I'll put that out as the first role of the board. And I know we're going to hear a lot of differing views from the different perspectives we have here today. I wanted to at least lay out a little bit in terms of, I was thinking about what the framework of thinking about this issue. There are two ways you can think about it from the board's perspective. You look at the board. You can look at it in, I think the traditional way is to approach it from a committee perspective. And you say, well, here's what the audit committee does. And obviously that with the financials, you've got what the comp committee does, you have what the governance committee does, what the risk committee does. And that's certainly, that to me, that's the traditional way of figuring out what the board involvement is or where the full board fits in. As I had thought about it, another way to kind of slice the same information is to look at the subject matter of the disclosure. Because it seems like to me there are several categories of disclosure that a company makes where maybe as we explore it, there should be an enhanced board involvement. And so let me just suggest three categories. One is the category of disclosures that are actually generated by the board. Things like the structure of the board or the board's diversity policy or refreshment policies or CEO compensation or the audit committee report. Those are all things that are actually, they're board information. And so maybe there is a special board responsibility or a kind of in that category. Second kind of bucket that it seemed to me is out there are disclosures about particularly sensitive topics where I think most of us think the board has enhanced responsibility. And I guess as I think about most of those, or many of them revolve around risk. I know some will say that risk is the most important thing that a board is responsible for. But if you think about things such as cybersecurity or sustainability or known trends and uncertainties in MD&A or compensation risk or risk factors, but the whole area of risk, is that a place where we think the board should take an enhanced involvement in the disclosure since they should be having an advanced involvement in the topic itself? And then the third category, which I mentioned earlier, and I'm looking down at Cindy again, but non-GAAP measures. Boards have always been involved by way of audit committees in the financial statements, but non-GAAP measures have become a particular focus today. And they're kind of a different situation in that you don't have any accounting standards for them, you don't have any auditing standards for them, and you have risk of management bias because generally non-GAAP measures are designed, they're involved with management compensation and performance. And so again, is there a special role for the board here in overseeing the company's choice of non-GAAP measures and how they implement it? And I know, Cindy, I hope you'll talk about it, but you've put out a tremendous publication on this that's in the materials about how you think that you and the Center for Audit Quality think boards should,
and audit committees
should be involved in this. So those are at least, I guess, another way of looking at this. I guess the other thing is we talk about it in addition to kind of approaching the subject matter of disclosure is the process by which boards should be involved. And, you know, I start talking about process and I've heard, I'll look at my two board members here. I've heard board members say, well, they send me the 10K or the proxy 48 hours before it's supposed to be filed. You get back comments on their bio and some typos, and that's what you hear from the board. That can't be what we think board involvement should be. So I guess I'm asking the question, if that's not it, what should it be? Because I assume, you're going to get to talk on this first, Peggy, but I assume you think that you should be involved in more than getting your bio right and a couple of typos.
Making sure they have my age right.
Oh.
And use the picture from 10 years ago.
Well,
I'm so speechless. I think I should just turn it over to you.
Peggy, Peggy obviously is a chief governance officer, has been, and was a securities lawyer, disclosure lawyer. But today, your hat is going to be as a director. But obviously, being trained as a lawyer and having that role at Prudential, that's going to influence your thinking. But as the director of Oxy Pete, how do you view this?
Well, I actually think that's pretty interesting because having had that background, I do understand the legal basis of disclosure. In fact is, as a securities lawyer writing disclosure, I was very big into transparency, plain English. And actually, I want to thank John White because I think the first plain English registration statement, John actually was underwriters counsel, and it was with his help, because there were a lot of people laughing at me when I said, no, I want to write something that people can actually understand. And one of the other things...
Peggy was a really nice client, by the way. I should point that out.
Well, John says that because I took him as underwriter counsel every company I went to, but that's because...
that was 3 different companies.
Yeah. But that was because of the forward thinking on really where disclosure should go and really what are the duties of a board. And for me, you needed to get, for some of the innovative types of things, and again, you have those legal obligations as a company for disclosure, but to really be innovative after talking to investors and trying to find out what they want, from the transparency as well as the communication, you really needed board support. So how do you get that from a board that really does not have the background of being a securities lawyer, being a corporate lawyer? And one of the things that I did is, particularly with plain English, I would hear in the boardroom the lawyer jokes. What would happen is you say you got the 10K 48 hours in advance, and it was just, it was gobbledygook legal, and they didn't even bother to look at it because it was so difficult to look at, and they did focus on their age and their picture and their bio. So for me, it was how do you motivate the board and actually senior management really to take this seriously and make it a legal but also a communication document. And because of the lawyer jokes, one of the things you would say to the board is, look, transparency is really critical. We go out, we talk to our investors, and they want us to explain things in ways that they can understand. And not only that, there's certain information that they really would like. And I know it's not legally required, but isn't this an opportunity that we're missing? For example, if you take a look at the Prudential proxy right now, there's all sorts of things that are not legally required. There's a letter from the board to shareholders, really the State of the Union, what they have done in the last year as directors. And it's a beautiful thing. When we started that, I don't think any other U.S. company did it, but it really did get the board involved. It's oversight. It's, what are the things that they focused on?
So who wrote the letter?
Well, that's, I wrote the first draft, and you need staff for that. But then they tore it apart, which is the right way for them to do it. And they could understand that. This was a communication document. This was saying what was most important, and in some instances what they were proud of, in some instances what they had more work to do. it also got them thinking when they do that, it's really for the past year, is really to do objectives for the year going forward. As a board,
Was this happening at the board?
Yeah,
or was this
no.
happening at a committee?
No, this was happening at the board. I mean, the answer is it starts with the committee, but then you get the full board. It's something that they get really excited on. Some of the other types of things is we started embedding videos in the proxy statement. And it was the lead director, again, talking about what does this mean. And I was told that I was going to go to SEC hell. And I didn't. But it was a great communication opportunity for our board to talk about it. And it became so popular that we actually did it to the chair of our governance committee, who really spoke about a lot of the non-financial metrics that were really important to our stakeholders and our shareholders. Talking about diversity, talking about sustainability, talking about our commitment to our communities, particularly Newark. We put all of that in the proxy too, because the board is really proud of that. And that is something, because of our intense engagement with our shareholders and our stakeholders, they wanted to know more about that. What are you doing for the environment? How are you sustainable? What are you doing, from diversity? So that really spawned, because of the board getting involved, it spawned more disclosure on diversity. John and I spoke about that. But we have disclosure. If you take a look at the Prudential proxy, we have disclosure on our diversity of our board. And we did that before, it was required, and we have tables, and we talk about tenure. And I think we're very proud that over 2/3 of our board are diverse. So
you think that, obviously your vote is that the board should be deeply involved in these disclosures.
But I think you have to be creative. It's like everything else. If you ask the lawyers to do it, and I love lawyers, I'm married to a lawyer. Although my daughters didn't follow our lead, I wonder why. But if you follow lawyers, they tend not to look at it as a communication opportunity. And so what you need to do is you really need to get the board involved in this. But probably the last thing I'll say, engagement is a very powerful tool. And bringing your board, and not the whole board, but bringing your board to really talk to investors and stakeholders, I think is very critical. One, for my career, is critical, so they didn't think I went native. It's very helpful, when the chair of your governance committee said, yeah, I heard that, they're focusing on that. But it's also then you get champions in the boardroom to say, so that they too can see around corners. They can understand what investors and shareholders want, and you can then put that information in your 34 Act documents, be it your proxy statement or your 10K. Or then you can put your neck out. We're a pilot participant in integrated disclosure. Again, as I said, we put a lot of information, particularly in the proxy statement, on information that we've been asked about. I think that shareholders, if they're looking to vote for a board, they need to know that. So I think engagement is another powerful tool. You're seeing it a lot more, that one or two directors are going out and meeting shareholders, listening to what they want, coming back and saying, yeah, we can do that. We can put more disclosure. By doing that, we actually, in our proxy last year, put in gender pay, our gender pay policy. Again, not legally required. SEC hasn't said anything about that. There's some shareholder proposals out there. That's something that more and more of our shareholders are focusing, so why not put it in?
Now, where did that idea come from? Was that board generated? Did that come from you? And
well,
how did that?
Well, what we do on a quarterly basis, and I'm talking now as a staff person. What I am doing on a quarterly basis is going through, the congressional, the governance, and all of the legal updates, changes, things that we're hearing from shareholders. How shareholders voted on shareholder proposals the prior year. So these are very smart people. So they get that, and they can see kind of where, again, what shareholders are looking for, where the trends are going, the information that we should probably be giving people to get out ahead on this. And again, it's not difficult. So the answer is it starts with updates. It starts with letting the board know, where this is heading. And they appreciate it. Many of the board members, too, are involved in either other boards or companies. The memo that I do on a quarterly basis, I know is shared with many because I get phone calls saying, could you do me a favor and give this to me before you give it to your board so I know what to expect because my board member is going to ask a question. But it just really educates them on what's going on in the environment and what our shareholders are looking for. What you're doing is you're making those documents into a communication and transparency and putting them in plain English.
Doug, you are former CFO, and you were obviously part, as a CFO, an integral part of the disclosure process. Now you're a director. How do you view from a director's seat, obviously with that background, and you're not a lawyer? Okay, this is good. Too many lawyers in this panel. I'm one too. How do you approach it as a director?
I thought about a statement I could make where I would offend almost everybody in the room because I'm going to assume that you're either lawyers or accountants, and clearly one of the roles that I think is important for directors to play, because after all, we do represent shareholders at the end of the day. That's our concern, is to make sure that disclosures are clear and understandable. And to offend most of you, what comes out, at least in terms of initial drafts, is usually not very readable or not very user-friendly. So I think it's important to be the one to constantly ask, what does that really mean? Is it clear? Do we need to say all of that? Et cetera. In terms of the process itself, so I'm a director on 3 public company boards, and we all pretty much run the same way. Clearly, we weigh in as board members on the 10Q, the 10K, the proxy, and important press releases, certainly the quarterly press releases.
When do you get the 10K and the 10Q?
Which company? Generally a week ahead of time, generally, with that. All of my companies have disclosure committees. I don't know if you want me to dwell on that or not, but it's important that they do have disclosure committees, that they have broad participation with the committees itself, and they all know the question that I will always ask, which is, what did you discuss that you decided not to disclose? So they always know that's coming, and generally there is nothing that they discussed that they didn't disclose to come forward. But I think that's important. All of my 3 boards, they keep minutes of the disclosure committee, et cetera. So we know what's going on there. The one area where it's a little gray, but where in none of my boards do we actually do this, is the quarterly earnings script. So you all know, I suspect you all know anyway, that what happens when you have a quarterly earnings call is that generally the CEO and maybe the CFO start out with some prepared comments, and then that's followed up with Q&As. And if they're doing their job right, they've prepared for the Q's and A's because they've written out logical questions that will be asked and have answers and so forth. And something that I personally do, I don't actually read the scripts. I think that's going a little too far in terms of oversight. But what I do is I think about what's happened during the course of a quarter and what are some of the questions, and I say, so tell me how you're going to answer the following, whether it's earnings guidance, whether it's perhaps a safety incident that happened, whether it's a competitive issue that happened, and we go through that. And I find that's generally helpful. In most cases, they already have thought about what I'm going to ask, but I think that's some value added in doing that.
Sharon, you approached this obviously at Aetna and prior to that AES. I mean, you've been a chief accounting officer for a long time. How do disclosure basically starts with you, clearly. I mean, the financial disclosure is frankly the first thing folks look at. There are a lot of other disclosures, as Peggy's referred to, that people are interested in, but bottom line is the financial. How do you believe the board, and you work with, in fact, we've had over the years a few of your directors here in and out since the center's been around, so I know Aetna pretty well. What should, in your view, should be their role? What do you think they view their role? And what's the right way to do it?
Yeah, so I would say, one, it's a great partnership between the legal community within the company and our external counsel, and then the finance guys. And so we all get together on disclosure and take forward what we believe to be the right things, those key things that need to be disclosed. And then it goes through our disclosure, management's disclosure committee, which you spoke a little bit about, the CEO asking the rest of the executives, is there anything that we have not talked about? Is there any item that is significant that we need to bring forward? And then making sure that our inventory of items is complete and that there's nobody else within the company who has a significant item that didn't get brought forward. So good governance within that process. And then as Douglas mentioned, we do bring that to the board or through the audit committee, talk through with the audit committee, here's the significant disclosures, here's the process that management went through with our disclosure committee, and to your point, any meeting notes or items that we thought might be significant but determined that we weren't going to share, that's our time to go through that with the audit committee. And then a subset of that is shared with the board by our audit committee chair. So it goes all the way through those three steps: management's disclosures, audit committee, and then the board. I think one of the things you talked about briefly, and I know Cindy's going to talk a little bit about, is non-GAAP and where that fits in. I think it's really important, in addition to the disclosures, that the board and the audit committee are interested in non-GAAP. And I think in this last couple of years, as the SEC has really weighed in on what they believe for non-GAAP disclosures and given us a little more guidance on what they'd like to see, I've seen a real increased interest from our audit committee and heard of other audit committees that are taking much more interest in what are your policies around it, what are the important decisions you made around non-GAAP each quarter. And I think that's a step forward. I think it's a really good governance practice. If I worry a little bit about the role of boards and governance and in disclosure in particular, it's about the competing priorities that the boards are faced with right now and how much focus can they really put on that. When you think about things like cyber and some of the political risks and things that exist today, there's so many things dividing the attention of the board. I think it's really important that boards maybe circle back and make sure that the time that they're spending on this important issue about disclosure is still appropriate. Are they still really focusing it, or have things like cyber and those big risks that people are facing today, and a lot of disruption and the strategy is being disrupted. Are they really thinking about that in terms of what they're disclosing and sharing those risks? I think the other thing that I would think about when I look at what boards' roles are in disclosure is the other sources of information getting out, and how does that fit? I think we have a very traditional way of bringing forward information through the Qs and the Ks and a set process that I described about management disclosure and then quarterly reporting process. And so what is in that pretty package, we're all very good at actually making sure we're meeting the letter of the law, we're trying to be plain English, we're trying to be transparent and speak to our investors. And so I think that actually works very well, and that's probably because of Peggy and people before her who really drove home that important message about corporate governance. What worries me a little bit is the information that actually gets out and is disclosed through other means, so through social media, mainly through social media, through our own website, but also through social media. And do we have a quick enough way for the boards to get involved when information comes out and actually ask the hard questions of, is that in context, right? So bad news gets out somehow, or good news gets out somehow that we didn't intend, and are we reacting fast enough to make sure it's in the right context so that our shareholders have the full picture of what they should? And I think sometimes we have to be a little bit innovative, and I'm seeing boards get more and more innovative with how they are reacting. Maybe they're having special, not not a disaster recovery kind of things, but just, hey, we saw these press clippings, we saw this information get out in social media, we'd like to get together with management and talk about, is that coming out? And you made a reference to that, I think, a little bit of during the quarterly process, and I think boards are having to add that in between those quarterly processes to make sure that the information is out. It's so easy for something to get out in social media these days and be completely out of context. You're like, don't believe everything you read, people. We have to put that into context for you, whether it's good news or bad. And I think it's really important that the boards play an active role in that.
Cynthia, from the CAQ perspective, the audit profession itself.
Well, so let me start first with talking about the financial statement audit, because that is what, every company, every public company is required to have an independent audit of the management prepared financial statements. And so we do know that investors value the financial statement audit, and the financial statements themselves make decisions based on the financial statements. But of course, that's all backward looking. And as we've gotten a flavor from the panel so far, and I'm sure Eileen will pick up a little bit more on, investors also use other forms of information that perhaps is more current to make their investment decisions as well. So it's a whole package of information that investors look at. But currently, for the most part, in today's system, the auditors are only attesting to the financial statement. And it's really important that there be a good relationship between the audit committee and the independent auditors, because the audit committee is who is responsible within a public company for overseeing the entire financial reporting process. So they oversee the work of the auditors, which is really important. So John, you've mentioned non-GAAP. Others on the panel have mentioned non-GAAP, because these, of course, are financial indicators along with key performance indicators that, in my mind, are maybe different than the financial indicators, but still really important, that the company uses oftentimes to measure their success and measure how they are doing. And because these are outside of GAAP, there aren't really standards or processes around the use of non-GAAP. Now, Sharon mentioned that the SEC has come forward with some guidance on how companies can use non-GAAP, things like prominence and consistency and comparability. That's important. But the question has become, as we've gone out, what is the role of the audit committee or the board on a company's use of non-GAAP? And is there a role for the external auditors to play in helping the company come forward with their non-GAAP information? So the CAQ has put out two publications, actually, one directed at audit committees about the questions they should be asking their auditors and management about the company's use of non-GAAP information, and then a follow-on document, a white paper that we put out that takes those questions forward and actually provides information not just for audit committees, but also investors, standard setters, and others to consider as a company is using non-GAAP.
These publications are in your materials.
They are.
Also, Peggy's proxy statement is in there as well.
And all of the publications that the Center for Audit Quality puts out are publicly available and free of charge. So if you don't have them in your materials, you can get them off of our website. What's important, I think, to know about non-GAAP is that they can be a useful tool. I think sometimes non-GAAP gets a bad rap, that there's a fear that maybe companies are trying to use them to make their numbers look better, make their performance look better, and that's not necessarily the case. It's a matter of how the company uses the non-GAAP information, and so this is where it's important for the role, and particularly I think the audit committee, to get involved, ask the company's management how they've prepared the non-GAAP information or the KPIs. Are they consistently being presented period over period, or do they change? If they do change, there could be legitimate reasons why a company changes its presentation of non-GAAP information, but explaining why they did that. And so we have, over the last year, held 2 roundtables. We're going to have a third one where we bring together preparers, audit committee members, investors, and auditors looking at this issue of non-GAAP. And a follow-on question that we asked during this is, what could or should be the auditor's role around the use of non-GAAP information. The thing that we've heard that I find comforting is that most companies with whom we've spoken have robust controls around their collection and their use and their disclosure of non-GAAP information. So much like on the financial statement side, on internal control over financial reporting, they have internal controls about the collection and disclosure and use of their non-GAAP information. I think it's important that the board understand those controls and are involved in at least making sure that those controls are being used consistently. And the question then becomes, do you want to have, and frankly, this conversation that we're having right now is applicable not only to non-GAAP, but to cybersecurity disclosures, to sustainability. There are a whole host of things that are analogous to this, but using non-GAAP is, should the auditor be involved in collecting this information and testing, not collecting this information, in testing this information, how the company is complying with their internal controls. And this needn't be a mandated attestation or some type of auditor association with the collection and disclosure of non-GAAP information. We've heard many of the companies, the larger companies, but many of the companies in our roundtables talking about how they do have their auditors be involved in this, that it's a private, not a part of the audit, but a separate engagement that is permissible under SEC rules, to have the auditors attest to, provide whether it's agreed upon procedures or some type of assurance over the information and the use of the information and the collection of the information.
Can I ask a question to Cindy and maybe other members of the panel, because it's gray to me. In the eyes of the SEC today, what is the auditor's responsibility, if at all, on non-GAAP measures today?
Generally speaking, there's not an SEC requirement on that, unless, of course, there's something in there that's inconsistent. So in the non-GAAP measures, if there was something that would be, whether it's through a press release or an earnings call or some other type of disclosure, if it's inconsistent with what's in the financial statements, then the auditor does have a responsibility to get involved.
Assuming it shows up in a file document.
Yes.
Right.
I mean, if it's
Yes, that was
just
my-
in the earnings release,
That was going to be my comment, John. I agree. I think that non-GAAP numbers for a long time were outside of SEC filings, and that the SEC staff made some efforts to sort of encourage people to bring some non-GAAP numbers into SEC filings, so we see that quite a bit. And to the extent that you do have a non-GAAP number in an SEC filing, then the rules that apply to non-GAAP measures and the new guidance that we put out a little over a year ago would apply, and therefore the same sort of certification of financial information and signing of SEC filings would apply, and therefore the responsibility for those numbers would apply to the people signing those registration statements.
And the auditing requirement comes in of information that is accompanying.
Right.
financial
Within the
statements.
press release, so one of my companies literally just sold yesterday morning. We announced it to Cisco. If you read their press releases, you'll see maybe the second sentence, adjusted EPS, EBITDA, these non-GAAP measures and so forth. So you're saying the auditor has no responsibilities for that because it's only in the press release and not in the SEC?
At that point, that would
That's
be
true.
right.
Eileen, all of this stuff is for you. What
Oh,
do you
boy.
think it should? What do you believe should the board's role in this? Because obviously the board is elected by you. You engaged with the board. What is this a board responsibility, or
So
is
I'm going to
this
get to the
management?
punchline. So we need improved disclosure, but I don't think we need more disclosure. And let me just back up, obviously, into that statement. So as an investor, our financial analysts, we're active managers, so we know our companies well. We do a lot of work on the financials that are published. We do understand GAAP versus non-GAAP, and by the way, the issue is big because the gap between the two is increasing over time. So there's a lot more attention being paid to what's in the non-GAAP disclosures. From a governance perspective, non-GAAP is becoming even more important for us because many of the compensation metrics that boards are using to gauge how to pay the executives are based on non-GAAP measures. And for us, as Cynthia mentioned, the issue is consistency. We don't mind them being used, but there are games that get played. The definitions of what's included in non-GAAP can change. So we really are beginning to question in our discussions with senior management when we engage in governance discussions exactly what they mean by non-GAAP and what is the definition to make sure it's consistent year to year. So it is becoming a governance topic as well as an investment topic. Generally, in regard to financial disclosure, we basically think, for 85 years of SEC oversight, we've done a pretty damn good job of it. And the issue is the non-financial disclosure items that are coming up more and more, which now are taking up and soaking a lot of the time by the board. And this includes a lot of the issues around environmental, social governance, what I would call sustainability or stewardship overall. And we notice that there is this huge debate, not surprising to anyone in the room, about whether or not these metrics, whatever they may be, should be formally included in SEC releases as formal part of the financial disclosures or not. And I keep going back to the definition of the SEC on what is materiality, and I think we, as investors, always want to rely on that and remind everybody it's what a reasonable investor would attach importance in determining whether to buy or sell securities. And while it's nice to know to have some of this information, is it material? Does it change my investment decision, certainly in the near term? And from our perspective, and again, these comments are mine, they are not necessarily reflective of the organization, but my team would agree that putting many of these non-financial disclosures in a formal SEC document would be a mistake. So hence, we've gone to, in this country, what's called now the sustainability report. And I would hope that every board director is aware of what the information is in the sustainability reports that are now being published online, and there are, again, some of them 80-page documents in and of themselves. They appear to be reports that appeal to broad stakeholders, not just investors. So I understand the need for it from a corporate perspective, because in those reports, you are talking about corporate culture, environmental issues, safety issues, and they appeal to employees, retirees, investors, and the communities at large that companies operate in. They are meant to be a good a statement of how the company is operating within all of these frameworks. From an investor perspective, only a slight piece of that is interesting to me, and that is whether or not the company is disclosing specific metrics around environmental stewardship, whether or not there are metrics, goals that are identified, whether or not they are independently being audited by a third party. And as you can imagine, there is a wide difference in the standard of this reporting regime. So some companies do an over and above board in disclosure around these issues. Other companies give very high level information without much substance. So there is a debate whether or not how these reports should be solidified into a standard operating framework. And from that, we've gotten agencies like SASB and the TCFD making recommendations to corporations on minimum standards of disclosure blanketed for everyone. Of course, the SASB has approached it industry by industry. That still is problematic in my view, because what they've asked for is, I think, over and above the materiality, in our view, of some of these issues. We risk overloading the investor community and the population at large by just considering that every piece of information is material. And I think we, as investors, we have to be very reasonable, take a step back and say, what is it, what information do I need to make an investment decision for the near term and the intermediate to long term? The risks around climate are clear. People are opining loudly about that. But we also have to be careful as investors. We're not in the position of setting policy. Policy is left up to government agencies, and we want to be in business of being able to suggest a good framework for disclosure that we can use as investors, as fiduciaries on behalf of client assets that we're managing. There are a number of issues, however, and they've been referenced before, that the board, in our view, really needs to be able to discuss and consider. And this is where improved disclosure would come into effect. Cybersecurity has been mentioned, but the issue around disclosure from our point of view is all about process control and risk management. So around sustainability, what is the risk in your business that makes it unique to you about the ongoing availability of the business franchise? From a consumer products company to a utility company, those risks are different. So it's important to at least talk about those risks and how the board is established a risk oversight committee and how the information funnels from management to the board around those risks. That is a level of discussion we're having now with board members and corporate secretaries who engage with us, but it's not yet really embedded in a paragraph or so in formal disclosures around exactly how the information funnels into a risk committee assessment and how frequently the risk committee is on top. Succession planning is a huge risk to the franchise, and that needs to have much better disclosure. It's not enough to say, yes, we do it. It's a matter of how do you do it? Who's involved in it? Are there internal candidates? We don't need names, but the process around succession planning, both for the, get hit by the bus scenario versus the long-term succession planning of the senior executives of the company is really key information that I think the board needs to be able to discuss. It is their responsibility after all, and we've seen unfortunate circumstances even in the recent past where succession planning was not done well. The idea of corporate culture now today is a bigger theme than it's ever been before, due to some very high-profile situations where culture has really not been paid attention to by either management or the board. We are spending a lot more time with board members discussing how they get their hands around the company culture. And we think that this is a big risk issue that, again, could well be served in some disclosure in the proxy on how the board gets its hands. Do they go out and visit company sites? Do they visit management without the CEO in the room? Do they able to have one-on-one conversations with executives and find out what really is going on? If there are issues, how are they being addressed and resolved? We do think that that is a very big issue today, more so than probably we've paid attention to in the past. We think that we could do with a bit more disclosure, probably better disclosure, not necessarily more of it. I don't need to read any more pages in the proxy than I already have to. But we want to be realistic about it as well. We have an issue in the capital markets here which concerns us, which is the lack of IPOs in the U.S. market and the shrinking of publicly traded securities that we as active investors can invest in. We are competing now much more today than ever before with capital markets outside the U.S. who are very willing to list companies. And so the more that we make it more difficult here in the U.S., in my view, for companies to disclose under a regulatory regime and to disclose information, for example, that is not really pertinent, and I get to the Congress's wise decision about conflict mineral disclosure and pay ratios, which is, absurd in my view. We need to be thoughtful and to think further what the implications are by asking companies and asking boards to do more when we are competing now on a global basis in the capital markets for both listings and continuing survival.
Can I pick up on one thing that Eileen said that I think is really important and kind of gets to the heart of this? And that is, you mentioned with respect to succession planning, although I think it gets to other issues as well, or other disclosures as well. You said you don't need to necessarily know the names, you just want to know that there's a process and a little bit about the process. And I think this is where we get caught up, because we tend to sometimes approach it as all or nothing, right? Investors that I speak with do not want to know how the sausage is made, if you will. They just want to know that sausage is being made, maybe what some of the key ingredients are, and that's it. And I think there's this balance between when people hear disclosure, they think that investors are asking for all of the proprietary information about how the company manages its business, and I don't think that's what they want. They just want to know that there are processes, what the processes are, whether it's around non-GAAP, that there are controls around it, whether it's sustainability, or whether it's some of these other things. So I think that's an important point that we often lose. And to your point about regulation, I think if we could encourage companies and boards to make those types of disclosures, we wouldn't need as much regulation, and it could be eased up a bit, which maybe that's what Rob.
Cynthia, as a director of a sausage company, no one's ever asked me what you don't want to know. Rob, the Fed's perspective, the SEC. Well, actually, you can't give the SEC's your perspective. Well, you come from the SEC.
Charles has foreshadowed my first point, which is that now that I'm with the SEC and part of the federal government, it's very important that I make clear that when I speak, it's only me speaking, and what I say does not necessarily express the views of the commission staff or anybody on the commission. I have 3 points today. The first one is disclosure and the board's role. I'm a disclosure lawyer historically. I do a lot of what John White does, and a lot of the work that I've done has been involved in making sure that the disclosures in a registration statement or a prospectus for a securities offering are the right disclosures and the right balance of disclosure. And I work now for the division of the SEC that's responsible for the rules that drive disclosure, that require certain types of disclosure, require disclosure of material information sort of necessary to inform investors about how they should vote or invest. And I think the value of good and robust disclosure cannot be overstated. I think it's hard to understand unless you've worked on disclosure before, the competing pressures around it. I mean, you heard Eileen say, we want better, not necessarily more. And you heard people list a whole series of topics that, well, shouldn't we have more disclosure on this? Shouldn't we have more disclosure on that? What about, and from my perspective, sort of historically in private practice, but also at the SEC, the judgment required to reach the right balance and to understand the competing pressures is a tough thing to develop. I think good disclosure lawyers, you know, like Peggy said, she's a securities lawyer and a disclosure lawyer. That you know, sort of experienced people can build that up over time. But as I think has already been mentioned on the panel, disclosure is not just a lawyer's task. It's really incredibly important that, since what you're trying to measure is the materiality of information when communicating with shareholders and potential investors, that you understand and that the decisions about disclosure are informed by business people. And in my old practice, the investment bankers were often very good at identifying what is an investor going to care about. And sometimes the way investors think about things is different than the way company management thinks about things. And so getting together a team of people that have different perspectives and can work through sort of how much you need to say in order to properly convey to people without misleading them, that's a really tough challenge. And it sometimes seems that in the context of disclosure discussions, the idea is, well, you should have told me that. Well, hindsight is 2020, and what we're talking about is people sort of making those decisions at a time when there wasn't, when they couldn't have 2020 hindsight, and getting the right mix of rules and investor engagement and understanding by the company of its business and what the risks are is a difficult job. So now, you know my views about disclosure being a team sport, but I would say that a company's management and the board of directors do have significant responsibility for the tone and content of the information about the company and its business that is communicated to investors. And as I think has been mentioned before, the SEC's rules do not specify the particular role that the board needs to take in disclosure. And that's the sort of the beauty of our federal system. We have state laws that govern the behavior of boards of directors, and, under the state law that applies to the state of incorporation of the company, and then we have federal law that imposes, in our case, the obligations to disclose material information. But the board, as I understand it, particularly in Delaware, has oversight responsibility. And in my view, that includes oversight of how the company presents itself and how it responds to and functions under the disclosure demands of today. And you've heard that there are a lot of them that are not necessarily SEC rules, but I would include the SEC rules in that responsibility. And my second point is on disclosure effectiveness, which is why I teased John about not stealing my thunder. The corporation finance staff at the SEC has been engaged in a wide-ranging review of our disclosure rules that are applicable to reporting companies. I think some of the concerns about having rules had been on the books for a long time as the market and the sort of this focus in the industries and the challenges of modern corporations have changed over time. We are looking to go back into our disclosure rules and find ways to update them to assist in the process of that difficult process of balancing the right information to be disclosed to investors. And there's, looking back a number of years, there's quite a bit of work that can be done in that space, and the SEC and the SEC staff has been doing that work. And so in thinking about this and putting out concept releases about it, the conclusion has been that we should comprehensively consider our current disclosure requirements and then make recommendations to the commission, to the SEC commissioners, about how to update them so to facilitate timely and material disclosure by companies. And another goal is to facilitate shareholders' access to that information. And the timing of access has been something that has been talked about on the panel already, and the numerous ways that people can get and share information today that they couldn't back when a lot of these rules were written. So there have been a number of releases on this. If you go back over the last couple of years, there's something called the SK concept release. And for you non-security lawyers in the room, Regulation SK is the part of our rules that requires disclosure about the business and the sort of current operations of the company. And so there are a lot of rules in there, description of the business, description of your securities, things like that. And again, we are looking to update some of those requirements. The MD&A, or management's discussion and analysis, is covered in that section. So it's very, very broad-ranging set of rules that applies to corporate disclosure. And if you look on the SEC web page, you can find a lot of the concept release, you can find requests for comment, you can find proposing releases. We're moving in the direction of making the disclosure initiative come to life. And just 2 weeks ago, the Commission issued a proposing release on a set of sort of modernization and simplification proposals related to parts of Regulation SK that was driven by Congress when they enacted something called the FAST Act. And the staff prepared a report last November called the FAST Act Report, and the proposals are basically what was in that report. And the Chairman Clayton has said that the proposed amendments are intended to improve the quality and accessibility of disclosure in filings by simplifying and modernizing our requirements. So a lot of work has been done, but there is quite a bit more to do. I anticipate that the division will continue working on these efforts. And Division Director Bill Hinman has said that it is important to look at our rules and make sure that the process of becoming a public company and remaining a public company is efficient and no more burdensome than necessary. And part of this is looking at our disclosure rules and also considering what we can do to facilitate capital formation. And that's important, and one of the themes of the chairman is when companies go public and remain public, then Main Street investors benefit from increased investment opportunities and increased transparency in the form of disclosure. Which brings me back to today's topic, which is the company and the board's role in disclosure. The most efficient and effective changes that companies can make in their disclosures comes from within. The SEC can write, sort of one-size-fits-all rules and can temper the one-size-fits-all aspect of that by including the concept of materiality. But the people that know the company best, understand the challenges, understand the business, understand the risks, are going to be the management of that company and the board of that company. And so I think, to use one of Eileen's terms again, the punchline on this is you don't need new rules to tell your story better.
So let me, I just want to ask a question off of that. So one of the things that I guess I've been focused on when talking with boards is whether they should get involved in having a company step back and rethink their whole disclosure process, not process, but the whole look of disclosure for the company. I mean, we've got this disclosure effectiveness push from the SEC and all the things we're talking about today. And so, if you're going to have a change in the company's approach to disclosure, it needs to come from somewhere senior. Marking up the 10K from down below is not going to, every year is not going to, how you're going to get a real change in disclosure. So when I was talking to an audit committee group about the size of the number of people that are in the room here last winter, I went through 10 minutes of that in a very, what I thought was impassioned way, that audit committee members should go out there and go back to their management and say, you should step back and we're directing you to relook at all of this. And I have to tell you, that everybody in the room just looked at me like I was from Mars or something. I mean, it was like, are you kidding? It's a legal compliance document. We're not getting into any of this.
I want to do a slice of life on that. When GE came out with their,
when I said this?
When GE came out with their, what I thought was a tremendous annual report with graphs and everything. If you haven't seen it, you should look at it. I thought, my God, this is the best thing I've ever seen. Yeah. And so I went to all three of my companies, and sure enough, well, we don't have to do it. It's this, Bob. We don't. We want to. It was frankly, it was too much work for them. And outside counsel, by the way, said no, don't do it. So, well, so the same dull kind of. Well,
so I'm curious. I mean, what is the reaction? I mean, should boards be stepping up and stepping into this, or do you agree with that? I was from Mars and we should just forget about all this.
John, I think you have to get them excited and you have to educate them. If you don't have champions and if the boards are really not passionate about it, again, looking at, what the expectations of investors and stakeholders are going to be in 5 years. When they get that it's too much work, it's not required, you're not going to do it. If you get shareholders asking for it, more likely you will. But as Eileen said, you want the right disclosure, not more disclosure. And if you go out and if you talk to groups of stakeholders and shareholders, they're going to have their favorite 10. And if you take the favorite 10 of everyone, you're going to have a longer report. So that's why you have to get the board involved. But they really have to be the champions. Most companies will not do it unless there's a push from someone, and it's most likely the board.
So if I could also give the contrast, because I think, Eileen, when you talked about not wanting more, but better disclosure, and then Rob, you talked about the disclosure effectiveness work that the SEC is doing to try to simplify the burden on companies, not to give less disclosure, but to make sure it's not duplicative and that sometimes there's even conflicting disclosure requirements if you look closely at some of those things. Then the void that's left there is not necessarily a bad void, but it does require the board then to step in and take responsibility, right? If you want better disclosure and the SEC is trying to make it so that companies have more freedom to disclose the information that's important to investors at that point in time, the board has to take responsibility for some of that.
Now, John, going to the former judge gets the last word, at least on the state law point. How does Delaware look at director obligations in this area? Obviously, you've got these federal requirements that you've got to meet. There are criminal penalties if you don't. But how do we look at it from a fiduciary standpoint?
Well, the directors have a fiduciary duty under state law to fully and fairly disclose all material information within the board's control to the stockholders when stockholder action is being sought. Much of what we've talked about today doesn't fall in that category, and as a practical matter tends to be more a matter of federal regulation. The question of what the board does is driven by its meeting its fiduciary duties. It has to rely upon management. It probably has to rely upon counsel and accountants in many of these documents, and it can perform an oversight function. It needs to monitor. It needs to instill a value system, call it culture if you want to, and it needs to make sure that the people who are preparing the documents understand that the directors will be reviewing them. Now, I don't think you can draft a proxy statement with a committee of 8 or 12 people who happen to be directors who probably aren't even trained to draft proxy statements. So they can't do it all themselves, but they've got to exercise some personal involvement, either individually or through a special committee. If it's an audit problem, let the audit committee deal with it, so that the directors are discharging their fiduciary duties. Now, interestingly, in the absence of a request for stockholder action, Delaware law does not require the directors to provide information about the finances or the affairs of the corporation. That said, the board has plenty of discretion to disclose what it wants to disclose, subject to business realities, subject to federal regulation. If the board voluntarily provides information where there is no duty to disclose that information, they nonetheless must do so truthfully and candidly. One of the things that I wanted to mention, because we're talking about directors, is what is their liability? And for the things that we're talking about today, probably not much. As a general matter, as long as a director is not benefiting from whatever the company's doing in a way that other stockholders do not benefit, and as long as the directors have acted independently, the risk of monetary liability is rare, simply because most corporations have an exculpatory provision in their charters that would absolve directors of liability for monetary damages as long as the directors have acted loyally and in good faith. We've talked about more disclosures and better disclosures. And there's a balancing, unfortunately, that has to go on here, and this is where the board needs to set the tone. But when there are new disclosures being made, we're launching a new disclosure initiative, there needs to be some concern of what are the consequences? Because there may be good consequences in that you're informing shareholders, that you're perhaps increasing the faith the stockholders have in the board. But on the other hand, you run the risk of inadvertently violating some requirement. You also run the risk of giving insight into the company's workings that might benefit competitors. So it's unfortunately, and it's already been focused upon today, there was, once upon a time, there's this thought that, well, geez, if we disclose more, that's good. Well, no, the focus needs to be on trying to make it better, because one of the problems that I've always worried about is you look at some of the paper that corporations give to shareholders, you look at the size of the print, the number of pages, and all of a sudden it is an overwhelming burden for the shareholders even to process it, and just expanding it does no good, because what you're trying to do is inform stockholders of what's important, what's material to their decisions regarding their investment. And if you bury them in mundane, irrelevant detail, you're not doing anybody any good.
Now, John, actually, let me turn to you, because I saw your kind of I'm going to save my question for a little later. No, go ahead, because this is a tough question.
Well, no, I wanted to start with a real-life question that I wrestle with a lot, but just, so as a disclosure lawyer, I end up helping companies disclose or think about difficult disclosure questions, okay? I mean, examples would be, how are you disclosing a recent decline in sales, or the status of a government approval of some product, or problems you're having with a new product, or, I don't know, a cybersecurity breach or something. But you've got a serious disclosure problem that you spend a lot of time on. And usually the advice that I'm giving when we talk about how much disclosure to make is that it's a continuum of how much disclosure you can make about what the particular problem is. There's a minimum that you need to be above, and if you're not above the minimum, I'm jumping up and down. But once you get above that minimum, there's a whole range of where you can fall. And so I spend often hours with management coming out somewhere on that continuum. But let's just assume often it's not at the high end of that. It's at the low, it's closer to the minimum level. And then I just sit there and think, and then obviously those 10Qs and 10Ks go to the board, hopefully with more than 48 hours to look at it. But I find myself, does the board understand the choices that have just been made here? I mean, how does the board feel about this? What's the tone from the board? I mean, and often I don't actually feel like I have a way even to reach the board on those issues. Management's made a choice along this continuum. It's above the minimum. But should the board be asking about that? I mean, Doug, you asked the question, what didn't we disclose?
Yeah.
But do you ask the question, what did you wrestle with? Or, I mean,
well, those
how do you deal with that?
Those kind of topics, which obviously come up all the time, the way they are handled, and I'm going to maybe punt this back to you or the rest of the panel, is in updating, you update the risk factors in your 10Q and 10K. So that's the way. So if let's say cybersecurity, what will happen is a risk factor will say we could have some sort of breach with it. We certainly don't say here's how many times someone tried to hack us or what have you. So that's the way it's handled in real life, and I don't know if that's adequate or not, but that's the way my company's.
Well, and I think Doug is right. The other thing when you ask that question, and particularly, having, if you are a lawyer and if you're a securities lawyer, that can be pretty dangerous. But what you do is you ask management, well, I see this disclosure, is it sufficient? And they will always say, we discussed this with our incredibly able counsel, John White, who not only that, and they'll give you the pedigree. So you know.
But then they'll say, John said it was okay.
Yeah, they
And John
will.
said, well,
They
it's
will.
above the minimum.
They
But John
will.
didn't say it was at the top end of the range.
Well, but I guess then the question is, well, where do you need to fall on that continuum? You know, from a legal perspective and from an SEC disclosure perspective, where do you need to go? Can someone give an opinion? And I mean, the problem with the board is you can't roll up your sleeves and take out your pencils. There are some things that you really and truly have to rely on experts for. You can ask those questions, but to second and third or fourth guess, some of your accountants or some of your lawyers, particularly if you say, yeah, I'm okay, but this is what the range is, that's very difficult, John. It really is very difficult.
As an investor, this is such a timely issue because, I won't name the name, but in a recent very high-profile cybersecurity issue, the filing was made that there was a material event. The discussion that I read was the filing should have been made as a severe impairment. And my first observation was, did the board have a say on how the filing was disclosed? I don't know the answer to that. But should the board have had a say in how that filing was disclosed?
Well, I think if
and then
there
what
are-
is the process for the board to get involved in that?
Well, I think if there's alternatives, the absolute answer is you have to tell the board what the alternatives are. And a really good board member will ask, it's not binary. They'll ask, okay, what are the options and why are you choosing door A instead of B, C, D, and E? And then you have that discussion. The wonderful thing, too, about having diversity on the board is you have different experience and skills for people to start asking more questions. And out of that, you generally, unless you have like the super expert, you're generally not going to have someone say, no, you got to do it this way. But if there are enough questions, management will
right.
take all of that into consideration.
Here's the tough question. This is the one I wanted to ask. And I asked this John earlier when we were talking about preparations for this thing. I said, what if you have a director or maybe a minority of directors who believes the disclosure should be made in a certain situation, that it is in fact material, and the management and the majority of the board refuses? What is, from a state law perspective, John, from a federal perspective, from a good practice perspective, what is that director to do?
I would say resign.
I assume you're posing that question to the far end of the table.
The very, our Delaware counsel. But I also am interested in our federal counsel, too.
Certainly go on record in the minutes.
Yeah, the state law question is an interesting one because in a merger context, you would simply disclose that a board member voted against recommending the merger. Whether I am sure there are times when board members have been voted down and or lost the vote and just sat by quietly while times went on. At some point, I guess it comes back to your personal moral and ethical commitment as to whether you can accept the majority rule of the board because it is the majority of the board that makes the decision, or whether you think that what's going on is so horrendous that you need to make a personal statement. And I don't know whether resigning from the board would be the appropriate step or not, because that may raise more questions than it answers.
If you believe your fiduciary duty to the investors is that the information should be disclosed, yet you're prevented from exercising that duty, how does the SEC, I can't ask you how the SEC looks at this, but what do you think about that, Rob? It's a tough question. No, but this is really where the rubber hits the road with directors and disclosure. We can talk about what we think directors' disclosure should be and how it should be improved, and we need to disclose more, but ultimately, that's going to be the critical issue for a director.
As part of Sarbanes-Oxley, there are rules that apply to how lawyers can act in this context, and since in a good, robust discussion that gets all the way up to the board about a disclosure issue, there will be lawyers involved, and they will be subject to the SEC's rules, and that may involve them either having permission to or to disclose outside the company, but that proposal for forcing people to disclose outside the company was pulled back. So it really goes up to the chief, legal decision maker in the company's at the company, and if the response that comes back is not satisfactory to the lawyer, then the lawyer may be able to, depending upon the ethics laws of where they practice, to report that failure to disclose, to the regulators.
Does the director have an up or out? That's clearly a lawyer, but does the director have a fiduciary obligation, all the way to my colleague on the far right, a fiduciary obligation to go beyond the go outside the corporation, or maybe not? I don't know, and I'd like to hear from our finance people, because this is typically where these issues arise. By the way, they come out of financial disclosure, and what do you do? John, thoughts? Do you have an obligation to go
Part
out?
of the problem is there are areas where you can have disagreement that would be on a continuum. If it's, I fall off the fence and go one way, they fall off the fence and go another way, I don't know that it's worth making a big deal out of it. On the other hand, if you have come across incredible fraud by a majority of the board, then you have a duty to come forward. And once you get on a continuum where the line is between you just go along to get along versus you've got to go public, it's totally different. The problem with these things is there are facts and context, and it's the context that drives what needs to be done.
I mean, Charles, there is an 8K requirement that if a director resigns, and I knew you were going to ask this question. I had meant to look for the exact words, but it's something about if you have over a disagreement about policy and some other things, that the director, in effect, has the opportunity to put a statement on file as part of the company's 8K that announces the departure of that director.
Well, because look, Doug and Peggy will both agree as directors, it is very hard to get your fellow directors to move, and I think, Doug, your example on the GE proxy is classic. I mean, rarely is a director going to go beyond what the lawyer advises, period. And so, but if we're talking about the board's role in disclosure, it really, what power does the board have over it if a majority of the board is going to simply rely on counsel, who basically says, I'd like you to do more than the minimum, but here is the minimum. And you're really kind of locked into a legal regime that maybe dampens down the enthusiasm for disclosure. But I don't know, Peggy, you're on a very big oil board. I mean, obviously you're a big disclosure person. Oil companies have never been known for fabulous disclosure historically. The industry hasn't. But what? How do you?
That line down. But.
No. I'm teasing her.
No. And you have a discussion, and you also have to, John. I think what you said is very right. There are some things. If it's fraud, it's fraud, and you really have to say, is this a kind of bet the farm type of thing? Is this something, or and I've become a little more humble, which is listening to others. So there's some things I may be really passionate about, but you really have to listen. And if it's that type of if it's that type of issue that there really is that disagreement, you bring the lawyer in. There's been one instance, well, actually two instances in my career, that's exactly what you did. You brought the lawyer in, and you put John or whoever the lawyer is really on the stand.
But you're going to get annoyed at me because I'm going to come in and say there's
and I'm going to say...
I'm going to say there's a range.
No, and I'm going to say...
I will tell you where the bottom is. I will tell you where the bottom of the range is.
And I'm going to say there's a one hand and the other hand, and if you had it, you have a third hand, but you're representing the board now, and so, tell me, do you think this is deficient? And I think that's where it really comes down to. And in another instance, the board, and it was kind of a minority, they went out and they got another counsel. But those were bet the ranch types of things. You don't do this over, and again, and you're right, John and Charles, they're mostly financial. And, you bring the accountants in too if you have to. So the answer is, I agree, there's a range, and you get a gut feel for this, and if it's, if he's saying it's sufficient, this is not fraud, you have to figure out, from an investor's perspective, is that lack of that next level of disclosure, is that going to be material? And that's the question I ask the lawyer, and I ask the general counsel, and you either get comfortable or you continue to argue for additional disclosure. Look, most boards are collegial. If they see that there are a few people that are struggling, they will, as I say, and most managements are too, if they see that this is distressing the board, there's a good relationship, this is really from a legal perspective, it's from credibility, it's from an integrity, it's your reputation, they'll probably go up a notch or two.
Well, so Doug, I would come back on your question earlier that you ask every time about what did you talk about and not disclose?
Yeah.
I would supplement that and say, what did you talk about a lot when you did come up with a disclosure, and tell me what the ranges of the discussion were.
Yeah, I cannot wait to hear what did the board know and when did the board know it on Miramax, on Equifax, on Wells Fargo. I suspect, like everybody else, we want answers to that. And clearly, if they knew at an earlier stage what we all now know, whole boards probably should resign.
So just from the view from management, I think I want to go back to what we were talking about a little bit earlier with Peggy and the role of second-guessing management. And I think it's admirable, and I appreciate, and I know the leadership teams that I've been a part of appreciate when the board lets management come forward with it. But I think it's also good to remember that we're all playing a role, right? We're all part of a team, and we all have our position to play. And so sometimes the disclosure decisions that you make are, here's legal's view, and they might be in this range, and then here's accounting's view, and we're in this range, and then here's the management or the leadership team, the CEO and others, and they want it to be crafted in a certain way, and we're looking for something that is from all of our standpoint, meets that special spot, right? And so we pick that spot, we bring it to the board. We can even talk through, well, here's what accounting thinks, here's what legal thinks, here's what the leadership team thinks, and why we picked that position. And we might be able to have a really robust discussion about that. But I think there's a role that the board can play, and I think you touched on it when you mentioned diversity of thought, is we're in the middle of it, right? And you're sitting in the middle of whatever that situation is, and you're trying to figure out what it means to the team and to all of these different things. And sometimes we need that voice of the board to be our reality check. And to your point earlier on that example, it's somebody to stand there and say, guys, everybody stop. Look at this from the outside. The disclosure that you just made it's not going to fit. That's not going to hold together, and you just need that kind of wake-up call. And so I think the boards should be very comfortable in playing that role and asking the leadership team to talk through those things, because we need that counsel sometimes. And so I think sometimes I've seen boards that are incredibly respectful to management because they believe in that management team, and I don't think it takes away from that belief in the management team if they're asking hard questions, because it does help us to think through that. And so I actually would encourage people to take that role, not to step back and say, I don't want to act like I'm second guessing, because sometimes we just need that input of a diverse group of people with the experience that our boards bring.
But on voluntary disclosure, which is, I think, a part of what we're talking about, that's a la the GE thing, is it realistic to believe that boards is currently comprised and relying on counsel, as boards do, certainly professional counsel, whether legal or certainly financial accounting, will they ever push the envelope? Can they, I mean, again, that's why I go back to that point, that lone director or two or three may, but do you think you can ever get a majority to agree with it. Obviously, in GE they did, which is extraordinary if you think about it. But and obviously they did Prudential, and where you've been, Peggy. But
Well, but
that,
GE,
that came from management.
GE and Prudential, I mean, they were talking about stepping back and just revamping the look and feel of their disclosure.
Yeah.
They weren't fighting over a particular
No, I'm
issue.
talking. And I'm talking
They were-
generally.
Well,
Yeah,
but,
not
but
over an
also,
issue. General, as a gentleman.
what is it? Success has many children. So, ask Mikey, which is GE or Prudential or some of the other companies. And if it's successful and we don't go to SEC jail because we do a board letter or videos embedded and that type of stuff, then you'll see others and we get kudos from people. Then what you'll see is they'll copy it. So the answer is then you'll see board members say, hey, I read it, it's good, we should be doing something very similar. And not only that, not only should we be doing something similar, if you take a look at things like diversity charts, we don't look that good. Maybe again, that diversity of thought, maybe we should be thinking more on succession planning, on getting a lot more, getting expertise in this area or putting, the skills matrix in. So the answer is it does grow. If it's successful, it will. GE's was difficult though because it took a tremendous amount of work. We volunteered to be part of the pilot for integrated reporting. It's mostly European companies. It's a lot of work, particularly when you're dealing with GAAP, a lot of work. And, I made a decision that I really didn't have 150 of our accounting folks that could work on that. So we were going to look at it really differently, which is we were going to take what was material and put it in a plain English way, in a way that investors could read it. So I do think you need incubators because companies will say, I don't have the time, we don't have the money. But if someone does it and they're successful, I think you see others following.
But look, this panel is comprised of people whose livelihoods and lives revolve around disclosure. That's what we all do. But most people on corporate boards today don't come from that background. I mean, they're operations people. They may be investors. It's a different group of folks. And the question is, how do you convince a group of folks whose knowledge of this isn't? This is what we do every day. How do you convince them that it's the right thing to do? I mean, as a former CFO, I mean, you can try.
Yeah,
but how does it work?
I think in general, at least my three boards, they know who are more subject matter experts, and they will default to what we're saying. One point that's not been made that I want to make is the role of outside counsel to the board or to one of the committees, because I've had some experience with that. And that can be helpful, particularly in the case that the regular outside counsel kind of kowtows to whatever the general counsel of the company wants to have done. And oftentimes, when you get another point of view, an advisor, separate advisor to the board, that can be helpful. Mm-hmm. What do you lawyers think, by the way, on that?
Well, it depends on what role I'm playing at the time, of course.
It's honest, at least.
Yeah. But, of course, the freedom of having separate counsel allows you to advise. Easy. I mean, the hypothetical I was posing before, I mean, I guess you could see if you spend all this, if you spend your time with management, you spend all your time hammering out a solution or a proposed solution with management, it gets more challenging if you are interacting with the board. I mean, you know who your client is. It's the corporation. It's not management, but it is still very challenging as counsel, and you're walking on a lot of eggshells in that setting.
One of the things that sometimes is difficult for companies in resolving questions about disclosure is they are often afraid to call the SEC for an answer to how the disclosure rules should be applied in a particular instance. And I guess I just want to say that throughout my admittedly short career at the SEC, I've been really impressed by the people and their dedication to the SEC's mission of orderly markets and investor protection and facilitation of capital formation. And I've also been impressed by the amount of collaboration and transparency and efficiency that the staff is driving to provide to public companies and to companies that want to register and become public companies in the U.S., and also companies that want to make sure that they're, to the extent that they're allowed to, finding an exemption from our rules and avoiding, reporting or registering securities. And that idea of collaboration has been a focus of Bill Hinman, who's the new director of the Division of Corporation Finance, and he's very focused on helping those of you that have to follow our rules and produce good disclosure. And we welcome discussions about how to present information in new and innovative ways and how to tailor disclosure to better tell your company's story. And Bill has also encouraged companies and their advisors to reach out to us with questions and concerns as they arise, in particular in the context of financial statement requirements. And the staff has the authority delegated from the commission to waive some requirements for financial statements when they're required in a registration statement or a SEC report. And that flexibility is under a rule called 313 of Regulation SX, and the division Office of Chief Accountant deals with these issues, and they also produce a financial reporting manual, which is available on our website. And now, just recently, they've included in that financial reporting manual the specific names of staff members that can be, that focus on particular areas where you might need a 313 waiver to give more direct access. And sometimes, historically, securities lawyers would say, well, you can't ask the SEC because they're regulators, and they think if you have to ask them, they have to say no. But the real answer is that there's a lot of expertise on the SEC staff, and we see a lot of questions, and we have a much broader perspective of how companies have dealt with concerns around the edges of following our rules, and sometimes we can give relief, and sometimes we can find ways for a company to provide the disclosure that would be helpful to investors, even if it doesn't, even if it isn't quite what our rules would require. So
Rob, I very much agree with what you just described. Having been one of those directors and having kind of watched the focus of the last 5 or 6 directors of CorpFin, different ones of us have focused on different things, rulemaking in response to Dodd-Frank and a variety of other things. With Bill, this is really, I'll say the first time, but where the real focus is on how the staff is interacting with companies. And he is very, very focused on that. And I will have to say, I don't think that has been the principal, kind of mantra of prior directors. And so there really is, I think, a different approach going on now.
Yeah, I would like to weigh in on that too, because I've heard Bill Hinman talk and Shelley Parrott and others in CorpFin, and they say the same thing that you've said, Rob, but perhaps more tellingly is a number of accountants who help companies with these issues, and a number of companies, and even boards of directors with whom I've spoken recently, really talk about the willingness of CorpFin to help the company through these thorny issues that sometimes present themselves, and that they really feel as though CorpFin is there to help them, that this notion of you can't go to the regulator because you're afraid you're going to get a no, I do not think is the case in this particular instance. And so I'm not saying it was the case in other instances, but certainly people are starting to feel that. So I would like to encourage everybody to avail themselves of the openness of CorpFin to address some of these issues.
But Rob, to finish up, one underlying thing you will get from CorpFin that's been there all along is they will tell you that the determination of materiality is to be made by the company, not by them. I mean, that's comes out each time.
The easy question. Let's go to the audience. Why don't we start off with the students from Finance 418? There are microphones up front. If y'all want to, anyone would like to start. You get the first dibs before we go to the audience itself. Oh, there's a question. Yeah, go ahead. Yeah, go ahead. We can hear you. I think we can hear you. We'll reproduce it to the rest of the audience. Go ahead. Yeah, go ahead. Ask a question. Yeah.
Well, I'll take that. Absolutely. There is. And generally, the way that happens is in the quarterly call, which, of course, is open to whoever wants to go in. So I don't think it necessarily belongs in the 10Q, but certainly your investors are going to ask those questions, so you need to be prepared to answer them.
And boards are going to ask those questions. Boards are going to say, because you're going to get a presentation on that before they go out, and you're going to say, I'd like to see those numbers.
From an investor point of view, there's been an ongoing debate about whether or not to do away with the quarterly call and to the quarterly guidance. And I think we would be somewhat supportive, but remember, most companies, if not all, have an investor day where they do provide the investor community with a forecast of the major metrics, including CapEx and capital allocation, et cetera, and projects. So those investor day forums remain to be pretty important, actually.
How important is one-on-one dialogue between investors and board members? Obviously, it's tough for directors to disclose. They can't disclose under FD, or if they disclose SB broad. But how important are those conversations to the investors? Engagement with not individual directors, but representatives of the board.
I would say that they are becoming somewhat more important, but not a need to have as of yet. So, for example, when board members want to come in and speak with us, they come in to speak not just on the governance topics, and I make it clear my investors will be attending, and we need to spend 20 minutes up front in the meeting on strategy. So if they're willing to continue to have that conversation, they'll have a full forum of both investors and governance professionals in the room. My investors like when they do come in. It's a reality check. It's a sense of whether or not the messaging they're hearing from management is consistent with the messaging they're getting from the board. It doesn't need to be frequent at all, but again, it's a nice to have right now, but not yet a mandatory to have.
I had an epiphany a couple of years ago because I, having been a CFO and interfaced with investors and so forth, I really questioned whether or not investors would learn anything from a board member. I thought they'd certainly learn more from management than they would us. But an investor said to me, "But wait a minute, this isn't about necessarily us learning from you. This is about you hearing from us." And I said, damn, that person's right. I never even thought about that. So I think in those cases, it's very important to have those kind of engagements, to hear from investors as opposed to expecting them to want to hear from you.
Yeah, but just staying my conservative lawyer self here.
Oh, here we
I mean, you said it sort of, Charles, but I mean, you can't say anything material in those
of course, and the lawyer
sessions.
is always in the room. So
I understand, but because you can't say anything material because FD says you can't, and the SEC is quite focused on enforcing FD.
It's consistency of message, and to Doug's point, I think it is important that the investor feedback directly to the board members attending, good, bad, and ugly, is heard. I do think directors really do appreciate that messaging.
Doug's point is the opposite, and it's very important. Yes.
All right, back to the audience for students. Any other questions from the students? That's one good question before we open it up. Okay.
You have one.
Oh, there is one. Okay, good. Going once. No.
Hi, my question was geared towards Eileen and Mr. White. You mentioned sustainability and environmental topics raised by investors. Is there a non-GAAP, non-financial disclosure topic that should be talked about more or even required that isn't?
Specifically with those, on those issues?
Just anything that any topic even besides that, that should be talked about more that isn't?
Well, I mentioned a few, these issues that I lump into non-financial have risks associated with them over the longer-term time frame of most investors' horizons, except, if you're an index fund, you own them forever, so your investment horizon is infinity. But so these, specifically with regard to climate change issues, these are very, very long-term issues. And while we all kind of want to know what companies are doing about addressing that issue, from an investor point of view, we want to understand what is the capital allocation that companies are applying to address the issue. What does that mean for shareholder returns? Does it degrade our expected return on capital, for example? And should we, or our free cash flow estimate, as companies are applying more and more capital to address these, I'm using climate as an example, but these issues that are very, very long-term in nature. That's kind of the angle that we like to take on the issue. But when it comes to topics like that, you have many investors with different perspectives on what's important around those issues. And again, I made the statement before, we are not in the business of setting policy. So we stay away from the policy decision angle. Is it a right thing to do or a wrong thing to do? That's not what we are attempting to address for our investors who are investing with us. It's really about the long-term return and cash flow forecast that we're trying to make in the companies we're investing in. Those issues obviously would have to be somewhat disclosed and talked about, and for just general financial disclosure purposes.
I think the one thing that you mentioned in the beginning of your beginning remarks that actually made a note of was that culture, that there needs to be disclosure of what is the board doing to monitor the culture, or something about culture. I think that is kind of a risk to the entire investing community that maybe we haven't paid enough attention to, and I loved that you brought that up.
Yeah, that is a big topic in light of unfortunate recent circumstances. As I engage with board directors on this issue, by far I'm getting very positive feedback on how the culture is addressed at the board level, and the amount of time board members do spend in the field, in the companies that they represent, understanding more and more the general management employee base without having the CEO in the room.
Yeah.
Charles, could I ask Eileen and Rob, one question I came armed today to ask. It's on non-financial reporting. The European Commission on December 6, 2014, issued a set of guidelines to EU headquartered companies on basically with some guidelines and suggestions around environmental issues, social employee matters, human rights, anti-corruption, and bribery. You all are both probably familiar with those. What's happened as a result of those, and are those good guidelines for U.S. headquartered companies?
We have quite a number, as you can imagine, of European investors that invest both in European companies but also in U.S. companies. So and they are very much on top of which companies are on the cusp or fringe of violating any of these issues. And in fact, there are third-party databases that collect all this information, and if you're on the list, you have to explain as an investor why you continue to own the company, or why or how you've addressed the issue with the company itself. So we are consistently, even as a U.S. investor now, having to comply and explain on many of these issues. U.S. companies have not yet necessarily made it on the list. There are other lists, obviously, and we talked about one of the issues in a company that you're on the board on too. So these lists are being generated because investors have companies they cannot invest in due to their own country regulations, right? So we have to be on top of it. We have not, in the U.S., formalized, obviously, any approach to those issues. We noted in the state of California, of course, when the insurance commissioner said divest of all coal, that was a mandate for that state. And of course, we had to be very vigilant with our clients who are in public pension funds that are in California and make sure that those companies were not in the portfolios and cannot be held in the portfolios. So there are state-by-state public entities in the U.S. now that are beginning to dictate. And, you know, tobacco has been on the list for a long time in many of the state government pension plans that they can't own it, and they're off, you know, they're out of the portfolios, they're off the lists, that kind of thing.
From the point of view of the SEC, the SK concept release that I mentioned before did ask for feedback about on some questions regarding sort of ESG matters, and we received more than 360 unique comment letters, and I describe them as unique because we often get thousands of form letters as well as sort of people writing in with specific ideas and comments in response to our request for comments and our concept releases. And the staff is considering the comments and other changes to our disclosure regime in connection with the concept release. These processes take a long time, and a number of the letters that we got asked for more ESG types disclosures, and so many of them expressed support for that. There was not consensus on what kind of information or how to present it, and one of the things that will need to be sort of wrestled with is what framework would be used for disclosures of that type, and there are a lot of very difficult questions embedded in what seem like simple things like environmental disclosure, but it's much more complicated than it sounds. So one of the questions is, should the SEC adopt a third-party framework like the SASB, or should we devote our own, create our own framework for those disclosures? And I think, you know, capital formation is an important goal of our director, but this process and the disclosure effectiveness review, which includes these questions, is ongoing.
I just want to make two closing comments on that. One, European investors are making buy-sell decisions based on third-party ranking of companies based on their environmental disclosure. So from a disclosure point of view, it's garbage in, garbage out. If you're a company that is thinking or currently disclosing on these issues, if it's not good information, chances are you could be ranked very poorly, and if you have European shareholders in your share roster, they could be forced to sell the company, the stock. The other issue I just want to make, Peg, to Rob's point on the SEC and thinking about organizing ESG disclosure generally, there are industry groups that have formed, I mentioned the utility industry in and of itself, that are trying now to devise and develop their own set of standards for the industry. They've done a lot of work. I think they're getting to release publicly their set of standards early in the year. I've been asked with my colleague to maybe do something with the API. I have encouraged privately in companies that I speak with to try to organize their industry groups to get to do what the utility industry has done. And because personally, and again, this is my opinion, not a JP Morgan opinion, I would not want to see, while I appreciate the work that SASB has done, I would be reluctant to want to find it in an SEC 10K.
And Eileen is so right, from a corporate and from a board perspective. These third-party raters that she's talking about, they're beginning. Their work is not complete. You know, they're finding their own. I actually have a full-time person now that's really focusing on these many reports that are coming out from all places, because all of them have to be corrected. And if I were to put all the information that they're asking for in a document, my SEC document would be, twice the size. It's just, and again, they're looking at you from a global basis, so they're taking non-U.S. standards and they're imposing them on you. So, more to come on that. I think there's just a small percentage of companies that are focusing on it. My companies, as I said, we really prefer to go out and talk to our investors to see where they are on these issues, and try to take the ones that are really material to us and are very important to them, so that we're not cluttering lots of documents. But then we have to spend time correcting these raters, and they're growing. They're every day they're growing, and they're huge. And some of them are looking at 1,200 kind of pieces of information in order to rate you.
Yeah, one way to get, or a possible path forward is, whether you're talking about SASB or some of these other frameworks, and I don't know that the SEC is going to be keen to adopt or endorse a particular one, but is if the company has the auditor attest to the sustainability report, then it...
And they are chomping at the bit to do that. There is so much money to be made in all of this.
Yes.
Law
It is
firms,
big business.
accountants, auditors, consultants. This is, hey guys, you're in college, you want to go into a growing business, this is the business to go into.
I did not pay her to say that. But if you think about it, right, like you look at a Clorox or a Coca-Cola or a GE, they are, as we've said about GE, certainly a leader in some of this stuff. And it's really about the risk to the company, the business case. That's what investors want to know. So for a Coca-Cola, what would a shortage of water look like to a company like Coca-Cola? Not because of their good stewardship of the environment, which may or may not be important to investors, but really, what does it mean to the long-term viability of a company like Coca-Cola, who's so dependent on water? That's what I think investors want to know. And whether you use SASB or GRI or any of these other frameworks, if you have some kind of attestation or association with it, it makes that framework less relevant than that you have a process that you've gone through it and you've made the disclosures that are material to the investors.
All right, let's go. I think, there's another student question. Wow, okay. Wow.
So just going off what you were saying,
There we go.
my main question is just, when it comes to like a water shortage or some type of environmental sustainability problem, do you believe that corporations do still have a responsibility, whether or not their product line is dependent on this type of thing, or just what's your input on that?
You mean outside of the business risk? What
Yes,
is the
so,
company's?
Like, do you believe that corporations have that responsibility for like the public as a whole,
Well, it gets
regardless if it's not going to actually help their company?
their bottom line. Well, it gets to this notion of culture, right? What is the company's viewpoint on making sure that their community is healthy, that their employees are healthy and have a good place to work, a good, healthy working environment? So I think these are more and more important to investors and to others, and that there is a social responsibility outside of the business case to be made, but that's up to individual investors, and I think you're going to have to see more investors calling for that to happen. I don't think that a company is going to do that outside of a business context unless there's a demand for it.
So
And
in the engagement conversations we have with companies, we do inquire about the talent pool, the hiring process, and sort of the culture of the organization, part of the culture conversation. Many companies in these stakeholder reports, as stewardship reports, are addressing all their stakeholders, including the communities and new employees. Millennials want to work for companies who have values that are close to their values. And companies are really bending backwards, I think, for the most part, in ensuring that they are talking about these issues in order to attract new hires into the company and to retain those new hires in the company for longer periods of time.
And you've seen a lot of work in Delaware, too, on the benefit corporations, and I think that's also going to be a trend. And, you know, I have a bet with my general counsel that within 5 years you will see a Fortune 100 or 200 company do that, but there's work to be done on, you know, the various laws and how would it be interpreted. And right now, it's really to maximize, you know, long-term shareholder value. But to the extent that you're looking at it from a stakeholder perspective, I think once it's a little firmer, you know, how courts are going to look at that, I think you're probably going to see, you know, even more larger companies. It's getting more popular in Europe. It's popular with some of the private companies, but you know, from a public company point of view, it's kind of hard because you don't know how to interpret it. But I think it's not only investors. It's you know, it's the millennials. They want to work there, and it's value based.
Yeah, if I can give one quick anecdote, we had the Chief Sustainability Officer of Coca-Cola come and talk to a group of women in the capital markets, and she told a story about how in the early part of the 20th century, so I don't know the date, maybe 1914, Henry Ford doubled the wages of all of his workers and shortened their work week to 40 hours a week. And why did he do that? Because he was benevolent and wanted to make sure that his employees had enough money to live on and weren't working too hard? No. He did it because he wanted them all to drive Ford cars. He wanted their neighbors to see the Ford cars in their driveway. But the end result was, regardless what his motivation was, his end result was his employees had a much better life, and other companies saw what Henry Ford was doing and added on to that. So your motivation from as a company doesn't necessarily have to be benevolence to see this knock-on effect that the company is doing good things for the community or for employees or investors.
Can we check in with the other John down there about the duty of directors runs to stockholders, not stakeholders?
In theory, it runs to the stockholders. They're the ones who vote. That doesn't mean that they can't, in carrying out what's in the best interest of the corporation and thus the shareholders, look to other stakeholders and other societal interests. It's a matter of the duty of disclosure runs to the stockholders. It doesn't run to interested persons.
Clearly, stakeholder under Delaware law, we're stockholder based. Yeah. In fact, all states, frankly, for a lot of reasons well beyond this panel. There was let's go to the audience itself and get it. There's a question way back. Yes, sir. Can you see it way back? There we go.
Charles, while we're waiting for the microphone, one area that I'm personally concerned with is that politics seem to be finding their way into corporations. The example I'm thinking of is when Trump made the insensitive comments about Charlottesville, and then the CEO councils, most of them walked off and so forth. And that bothered me for a lot of reasons, but particularly I'm thinking, oh my God, here we go with corporate America walking out, and where's this going to end up? And with the political climate we have right now, I don't know, but it feels like it's starting to really seep into corporate governance and corporate communications and so forth. And I think that's a
well,
bad thing.
there's always been a divide between the two because corporations have such diverse constituencies of shareholders. They represent all political opinions, and that's why traditionally companies were forbidden from making political contributions directly, because the idea was that you're using other people's money who may not agree with you. And I think that to me, it's always been the good rule. You know, there's certain things you don't talk about in the corporate setting. Should be politics, but you know, because it's going to be divisive no matter what you do or don't do with it. Okay, the way back, we got the mic. Go ahead.
Well, I'd like to first thank all the panelists for their tremendous insights. Learned a lot of new things today. One of the new things I learned actually is that most firms actually have disclosure committees. And then as I quickly Googled, disclosure committee is a management committee. It's not a board committee. So my question is, given the critical role that boards play in disclosure, why is disclosure committee not a board level committee? Should it be a board committee? And what are the considerations or constraints that are currently prevent it from being a board level committee?
Good question.
So,
Well,
oh,
yeah,
go-
well, the question was where disclosure committees fit in. I mean, if we go back to Sarbanes-Oxley and the requirement for certifications by the CEO and CFO, they began to step back and say, how do we support that certification? And also the requirement that a company maintain disclosure controls and procedures. A question became, how do you put that in place? Disclosure committees were set up as part of management's process to support the certifications and to show that you had disclosure controls and procedures. And I think they work quite well, and most companies have them, and they work effectively to help percolate information up to the CEO and CFO in the disclosure process. The question of whether you should have something equivalent to that or some role at the board level, I think is
well, I think you
it's
almost,
kind of a different question.
yeah, but I think you almost do with the audit committee. If it works the way that it's supposed to, where your leaders across the company are speaking and in support of those certifications, to your point, to the CFO and the CEO about why they should be comfortable certifying, what procedures have we done, what controls have we looked at, and what were enacted in order to support the financial statements, and then from very specifically around the disclosures we considered, which we selected, and we make all of those disclosures in that process, and then they take that forward. So our CEO speaks to the audit committee and talks through what happened at the disclosure committee meeting, and then as the chief accountant, I walk them through what disclosures we're making, and we walk them through the internal controls, all the same topics that we talk about at disclosure. So it's actually, I would say the audit committee is the extension of the board level audit committee, or of disclosure committee, and then they give a readout to the board on how they got comfortable. So I do think they all actually roll into a disclosure process.
So you're saying the audit committee gets a report of the issues discussed at
Yeah.
disclosure committee?
And I would consider that to be an extension of the disclosure committee up to the board, which is through the audit committee.
Interesting.
Yeah.
Oh, there's a hand in the audience. She's going to tell us we got a break for lunch.
No, not at all. It's on?
But we're
I don't know.
hungry.
Is this on?
Sorry.
Yeah, okay. No, I just wanted to say, I mean, I'm the associate director of the center now, working with Charles and Jerry and Louisa, but this is a more substantive comment, I think, in response to Faye's question, because in my prior life, I was a chief corporate securities lawyer for Sunoco, and to John's point, before Sarbanes-Oxley and before we had management disclosure committees, really largely the SEC reports were done by the lawyers, which would have been my group, and the accountants. Okay? And it was very sort of stovepiped. And the business unit people, out in the various business units, the management, the other members of senior management were not really that involved in the disclosure process. Okay? And my observation was that the Management Disclosure Committee was a huge improvement because now you had a management committee comprised not just of the lawyers and the accountants, but all of, you know, the SVP of operations, the SVP of this unit and that unit, and then they would talk about what their issues were and what they were worried about. And so the discussion got much more robust, I think, at the Management Disclosure Committee when that opened up. And then now, you're absolutely right, it now goes right up into the Audit Committee. But I think that that management improvement was really seismic in a lot of ways.
Yeah,
and I think a lot of times Management Disclosure Committees don't get maybe sort of, we don't talk about it enough, but I think it was a huge improvement in terms of SEC disclosure.
Yeah, and if I could
Good
quote
question.
SEC Chairman Jay Clayton, who at a recent talk at the Brookings Institution, he talked about the disclosures and the role of the independent audit committee over the financial reporting process as being one of the greatest investor protections in the last 25 years, in his opinion. And this gets to, I think, Sharon's point that the disclosure, management's disclosure committee, the next step is going to the audit committee, who has a responsibility for overseeing the entire financial reporting process. And so even our SEC chairman has acknowledged that.
The audit committee, for better or for worse, is your chief, I think, board-level disclosure committee. And I think, John, you believe it ought to be broadened beyond that, but in fact, that's where it happens.
Yeah. Well, actually, in this space, I think the most powerful thing that happened was requiring the CEO and CFO to sign the certification. I mean, I think it just scared the heck out of them and has resulted, I mean, ever since CEOs, they were always responsible, but once they had to write their name down every quarter on that certification, they paid a lot more attention.
Well, having worked at a large financial institution, the Bank of America, it's not just the CEO and CFO who are certified. There's all those sub-certifications
Yeah, I mean,
below.
there are companies, hundreds of sub-certifications.
Yes.
But that's because the CEO and
Which is a good
CFO
thing,
have to
yes.
sign it, and they want everybody below
be on
them
the-
to be on the line
Yeah.
to back them
Yeah,
up,
no,
right?
It's
Yeah.
very daunting.
Definitely true.
Right, Sharon? Sharon, you signed one, right?
I signed lots of them.
All right, we have time for one more question, because I want to get you out early for lunch. Anybody have any other questions? Time for one more.
One back over there.
In the back, okay, great, go ahead.
Hi. Cyber risks seems to be the topic du jour, and I've looked at these disclosures about cyber risks in a lot of proxy statements, and it seems like sometimes you have the same lawyers writing the same statement for different companies. Usually they change the name, sometimes they don't.
No, we mark up the precedent of the other company. It's not the same lawyer.
So my question is, maybe it's a certification. How can we make these disclosures more meaningful? Because it seems like right now it's not that meaningful.
Well, I think you have to go back to the risk point, right? What's the company's risk? And Eileen, you mentioned a recent high-profile case, and you talked about the disclosure after the event. If you look at that company's disclosure prior to the event that was publicly disclosed, in their proxy statements, they mentioned cybersecurity risk twice. And this is a company who had everybody's data themselves to be providing protection against some of these information breaches. And so you have to ask yourself, did the company pay attention to their particular risks in cybersecurity? And it's going to be much different for a defense company or a data security company than it is for a manufacturing company or an insurance company. And so, how do you talk about the risks to your company is really a responsibility of not only management, but I would say the board.
Well, with that, first of all, I want to thank the panel for a terrific job. Thank you, and I think
Thank you.
In my boilerplate the disclosure reminder, those who sought CPE credit need to sign out, as well as the CLE folks. Lunch is going to be outside, but I also have to say to John White, thank you. I have to tip my hat, because when John first proposed this idea, I was like, oh no, disclosure. But, it really turned out well. And I have to say to Al Kennard, wherever he may be, you were right. It's pretty good. But thank you to the audience, and thank you to the Weinberg Center staff for putting a great program together. And we'll see you at lunch.
And thanks to you, Charles.
Thank you.
And Senator Audit.
Thank you.
Thank you.